like young people here. I was creeping in the chat a little bit. um, so actually, give me a thumbs up in chat if you're like under 25. I'm just curious because I might be the oldest guy here. Show a payout? Sure, man. We can show a payout later. At the end, you can ask me later.
Who was that? Who was
21,
that?
22. Nice. Okay, yeah, there's a lot of young folk here. And it always gets me excited to see just so many people just starting to get into the mix of trading and then finding out that options exposures tells you more than a lot, just a lot more than candlesticks, tells you a lot more than chart patterns, right? So a little bit about myself. Well, my name's William. They always call me ABJ, Apple Bottom Jeans. That's kind of pays homage to the first stock that I ever purchased, which was Apple way back, like first year out of high school. Started trading 2017-ish. Started to dabble. Lost a lot of money from 2017 to 2019. Just continued losing money. Wasn't until 2019 middle, like near the start of 2020, when things started to change for me, and that was when I started to focus up on options Greeks, right? Like what actually the number, like what are all these numbers beside the options chain that no one else in Discord, no one else online tells us about? There must be something there. Like, so what do market makers look at? What it is that they need to accomplish, and then from there, we always say that, hey, why do market makers always win? Well, it's because of the way that they structure their portfolios based on delta, gamma, vanna, charm, row, speed. There's all these things that a lot of retail traders just don't kind of focus on. And so getting involved with quant data, that happened in like 2022. 2022, yeah, 2022, I quit my job. I used to work at the border. And then 2024, quant data picked me up as a partner. So that's kind of my journey into trading. I know a lot of you guys trade futures. I used to trade with futures. I used to trade with Top Step. I think yen carry trade though. After that fiasco, blew up my live account. I was like, this isn't the way anymore. Couldn't really figure it out. I think there's a very big difference between futures and options, and that is time of entry, speed. Because for futures, if you are not quick to the trigger, you're kind of punished for not being able to get the best entries. And with options, we're allowed to breathe a little bit more. If we don't get the perfect entry, it's okay. There's still value in those options contracts. So that's kind of what I'm going to go over today with you guys. So options, whether you're trading futures, stocks, options, of course. If you're trading the New York session, you actually kind of do have to pay attention to the options exposures because during the time frame that the New York session is open, about 10 times the money goes into options premiums than it goes into futures premiums. So buying and selling of futures is about 1/10 of options. I'm going to show you really quick what I'm talking about here. So we go to gainers and losers. So this is today, and this is just SPX. Okay, so if we look at bullish premium, bearish premium, you can see that cumulatively we had like over $11 billion of premium traded just within the time frame when New York session is open. So a lot of times when you're trading futures or you're looking for direction, when we see things like, I'm going to bring up an example before I go into my little class here. If we see an example, like let's go to one of the greatest setups that we've had in a long time, May 13th, right? And we see this. You can see that the entire market is just all calls, right? Does it make sense for us to look at anything else? Does it make sense that the market is probably just going to grind upwards? Going back as well, let's go to, I think, someone might have to remind me, can't recall exactly, but I think FOMC was what, June 17th, was it? Yes, it was. So let's go to June 17th, right?
I think it's 17, yeah.
Yeah, at FOMC. So this day we had $30 million worth of puts, flow into the market before the press conference. What does that tell you as a trader in the market? If you're looking for direction, what does that tell you? It tells you that they've already made the decision of what's going to happen, right? A lot of people are speculating, oh, he's going to wear a green tie or something, and someone's going to do this and someone's going to do that, or he's going to say some words that are very hawkish or very dovish. We don't know. But like over in quantitative, you're just kind of tuned in on the data. You can kind of already see, well, who is going to risk $30 million of out of the money puts on a day like FOMC? In chat, let me know if this makes sense to you right now, because this is just one tool that we have over in QuantData. This is Net Drift, one of our favorites. If you go on my Twitter, you can see the filters that I use specifically for SPX. All those filters have been back tested over hundreds of intervals so that you can kind of use the best ones. If you're using for something else, right, you might have to change the filters up a little bit. If you are on my Twitter, you'll see that a lot of the things, all of the studies that I post, they are specifically geared for SPX because I just trade SPX in the intraday. Okay, so if that makes sense, I'm going to move on. I'm going to actually start the session that I wanted to go over. And I titled this one Beginners Beginners Basics, I guess, to looking at options data, looking at data in general versus chart patterns. So if you guys have seen my streams, or if you guys have seen me do my thing, you'll know that I don't have anything on my charts. They're completely blank. I know a lot of you guys with like ICT or SMC backgrounds, you guys draw boxes or whatever with gaps and stuff. Those are good. Those are just, those highlights, closes and opens of the New York session for myself. I like looking at those as well. Seeing the overnight inefficiencies, for example. I know some guys talk about that, but aside from that, right? There's something that I think is really peculiar with new traders that come into the marketplace. So for everyone who's brand new, you guys know, let's just imagine these are candlesticks, and excuse my drawing, okay? So this is what the market's doing, okay? And this is what most people will draw. They'll just draw this little chopstick thingy, right? So everyone knows, like, what is the expectation for price when we break through these two lines? What is the expectation for price? In the chat, just let me know. Just scream it out. And I'm not knocking anyone for doing this. Like, if you can pay your bills with this stuff, like, by all means. Breakout, right? You're expected to see some sort of breakout, right? So what is to stop price from just kind of doing this forever? Nothing, right? Nothing stopping price from just kind of dwindling along and just kind of doing its thing, right? What you're expecting for a breakout is someone to do something here. You're expecting a bunch of buyers to buy here, and price is going to go up. Otherwise, we do nothing. Otherwise, we come down, right? But that in itself already tells you that this is probably the wrong place to look. These candlesticks don't actually tell you anything. Quick note for everyone in the chat. Do you think, realistically, do you think the guys managing billions and billions and billions of dollars, maybe working for Warren Buffett or maybe working for JP Morgan, do you think they press the buy and sell button when two lines converge on the chart? What do we think? Because if you think that, I don't know what kind of drugs you kids are using nowadays. I just take Tylenol, right? That's my thing. But right, they don't look at chart patterns. They don't look at candlesticks to determine whether they should be risk on or risk off in an asset. They look at value, and they look at what the options market is going to allow them to leverage, right? Does that make sense? So that's point number one. These lines are great if you need to use them to manage risk, maybe a visual over and under for yourself. Like I like the VWAP for that. That tells us like the middle of the day, right, of what's happened. But let's start fresh. So we're not going to save this because that's a terrible drawing. But here's my other issue with chart patterns and lines and all that. So let's say we have a guy named Ben. So this is Ben, okay? And then we have Jim, okay? And then we have Fred, and nobody likes Fred. Fred is like just it's a weird guy, he eats worms at the playground, right? So Ben sees Spy and he sees this, right? So he thinks, oh, Spy's gonna, we're gonna juice up here. And then we show the same thing to Jim, but he sees this, right? And then it's like a head and shoulders or something, right? And then we see Fred, we show Fred the same thing, and then Fred goes, oh, I see this thing. Like it goes like this, right? Right. He sees a dinosaur, right? Who's right? Right. Fred's clearly smoking something, right? He's Fred's on trust. Yo, VTR James, what are you posting there, sir? Um, right. It doesn't make sense, right? So how can three different people look at the same thing but come out with a different idea of what's going to happen, right? So that tells me from all the years that I've been trading, everything that's on the chart is someone's opinion, right? It's just based on someone's opinion. That's all they want. They're just giving it some sort of idea. There's also no probabilities matched to it. There is zero probabilities of I mean to this date, I've been at this 9 years. I've never been able to speak to someone and ask them what's the probability of this breaking out right now, and they go, oh, I don't know, like 50. Every time I buy calls on a triangle, like it goes up, right? Have we heard that in the chat? Let me know. Like these people who like just give these random numbers, right? Over in QuantData, if you watch the things that we do, if you read through the studies that we posted, what are some of the numbers that we actually post out there? So probability of an MVC pivot, right? I'm gonna give all this alpha in the end, by the way. 54%. How do we get 54%? It's by backtesting something over hundreds of intervals, right? What is the probability of price closing beyond a gamma MVC? 28%, right? Like these are numbers, or 18%, sorry. These are all numbers that I can tell someone, and someone else can take this data set, and they will be able to repeat it, right? So that's that's the idea against this stuff, right? And so, in my opinion, from how I've found success in the market is by throwing all of this away. All the things that I learned like way back in the years, trend lines and moving averages and things like that, I just throw it away because here's what I can see. I know that if I go to Ben, I go to Jim, and I go to Fred, and I show him that FOMC is happening at 11 p.m. or 2 p.m. EST. Sorry, I'm East Coast. There are currently $30 million in puts and only $2 million in calls. What do you think everyone is going to do? Like all three of these dudes. What do you think they're going to do? Are they not just going to blindly short the market because it makes sense? Or are they still going to try to draw this stuff like Ben? Makes zero sense, right? And so a lot of people think like, oh, this stuff is so hard. Like, I don't understand. Why do we need to do math? Trading is hard. Alex knows this too. Trading is very hard. For everyone who's remotely, even like a little bit marginally successful in the markets, it is not easy. If anyone can really just draw two lines, make a bunch of money, then you wouldn't even see me here. I wouldn't even be with QuantData, right? So we don't trade off of opinions. We trade on factual data, and that is going to help us, right, determine what's the most likely scenarios for the market. Now, we're going to start to dig into a little bit about DEX and GEX and VEX, and we're going to leave out Charm. I'm going to do that for a very specific reason. Charm is a Greek that's very situational. We do have it in QuantData, but what I mean by situational is that Charm is more so based on time, and what we found is OPEX, end of month, beginning of the month, these specific dates. That's only the time. That's kind of the only time that we need to really focus up on Charm. The other three, though, we can use almost every single day. Okay. Now, I'm not going to explain delta and gamma and Vanna, the normal approach. Okay, not the normal approach. And so, are you guys ready for this one right here? Because we're talking about it in a very cumulative manner. I'll drink some water here. Sorry. You guys know I also stream it like every day, and so my voice gets a little parsed too sometimes. I'm gonna delete this because we don't need that. Car people, do we have car people in the chat? What are we whipping? How many people here drive a Civic? The worst car ever made. Let me know. Be honest, man. Be Lambo truck. Oh, there we go, dude. There we go. That's what I like to see, man. 1986 Nissan 3. Oh, that's this guy, the tuner guy. Tuner guy. Okay, so delta and gamma. We're gonna go through these two first. So not the traditional way to look at it, but in my opinion, the best way for me to understand this stuff is to kind of make it a little bit humorous so that it makes sense, right? I'm gonna really quickly go to notes here, and I'm gonna show you really quick math. Just really, really, really basic math. Okay, so let's say an options contract call option is $1. Okay, delta is 0.2, gamma is 0.2. 0.2. Let's just do 0.2. Price is currently, let's say, $100. So the value of that option is currently $1. Delta is 0.2, gamma is 0.2, price is currently $1. Now I know there's a little bit of math. Try your best to follow along. This is important. This stuff is important. Okay, so let's say stock goes to 101. What is the price of the new option contract now? Right? Very simple stuff. Very simple stuff. It is 1.2. Right? So this is going to lead up to my next example, by the way. So this is going to really help you guys in the chat there. So 1.2. How do I make my? Sorry, let me mute this stuff here. Got too many friends trying to post me things. So 1.2. Now, what is the new delta? That's where people get confused. What is the new delta? So it's not 0.2 anymore, right? It's 0.4. 0.4. So what happens when price moves up $1? Delta is compounded into the premium, so the price of the option contract. That's why it goes to 1.2. But gamma compounds the delta, so the new delta is now 0.4. Well, 0.4, not 0.3. 0.4. So what do you think happens when price or stock now goes to 102? What is the new call option price? What's the new call option price? It is 1.6, right? 1.8. Where are you getting 1.8 from? So you take the new delta and then you add it to the options contract, right? It's addition. Yeah, it's addition. So you can just imagine what happens when price goes to 105. So when we imagine this kind of math, this basic math here, 105, right? Which Greek is actually the driver of the premiums? Is it delta or is it gamma? It's gamma, right? Because gamma is the one that's increasing the deltas, and the deltas end up being overblown, right? And then adding to the premiums, right? Now there's a ceiling for gamma, right? Eventually, when contracts become like in the money, the gamma value no matter like doesn't matter anymore. And so this is going to lead us into a very good demonstration, a little bit of a drawing, a little bit of demonstration. I know you guys like my artwork here. If anyone's like screenshotting this and selling it for NFTs, let me know. I would love to partake in some of that money. Okay, so I asked you guys if you guys are car guys. So a lot of you guys are. See, some of you guys drive some nice whips. So this is an engine. Okay, this is an engine. I'm gonna write Dex. So Dex. So what happens when you have a car? Okay, and it's like a little Fiat. You have a little Fiat, and you press your foot all the way down on the gas pedal. What happens? You get smooth, linear transition and speed, right? You just get like a very um, expected move, right? With delta, like the engine is just gonna do its thing. You're gonna drive forward. You're gonna go up at a regular pace, right? Now, what happens if you add a? This is supposed to be a turbo, by the way. I don't know what happened there, but this is Gex. So now you have the same car, same engine, but now you added a turbo. So what happens now when you put your foot on the gas? What happens? Right? You get this kind of explosion, right? At some point in the rev range, you will get this. Right? This is where gamma kicks in. This representation right here is what you can expect when your contracts become in the money. You get that explosion and then you kind of get this like peak, right? In gamma. Like that's we're not gonna go like any more of like a turbo. Like the turbo can only do so much for that car. Does that make sense? This is making sense to you guys so far, right? So you have a delta tells us the flat rate of the move, gamma values, right? I'm going to show you guys on QuantData after, but gamma values tell you what the ramp up might be, right? When we get that contract in the money. So this tells us the contracts that have the most gamma exposure. So the most gamma exposure usually tells us there is a lot of value in that options contract. Now, Vanna, I'm going to go over Vanna too, just because it does matter. It is a very situational Greek. It depends if volatility is high. Otherwise, volatility is low, Vanna is like out of the picture. There's no reason to look at Vanna. You're really just focusing on delta and gamma. Okay, so Vanna, this is the way that I remember it. Okay, so this is, you guys will see right here. This is Vanna. This is Vanna. Okay, here's the scenario now, boys. I'm assuming most of you guys are gents because not a lot of female traders in this crowd. I know. Okay, so here's the scenario. Pay attention. You are driving in the car. Let's say Alex there is driving in his car. And he's going, he's going, he's going. And then all of a sudden his girlfriend says, "Hey, I need to pee." What happens? So you're driving, you're driving, you're driving. Two things happen. Two scenarios happen. Either your car all of a sudden gains like 50 horsepower. Okay, there's that volatility expansion, right? And all of a sudden your car gets 50 horsepower. Now you can like speed home, so your girlfriend can go pee, right? Or we hit road bumps and she's unhappy. She tells you, "Oh, I need to pee, but you need to slow down. You're going too fast. I'm about to explode from all the bumps on the road," right? So then in that scenario, this doesn't happen. It starts to taper down, right? This is volatility, right? Contracting. This is volatility not going in line with the idea that you have to be a speed racer, right? So that's why I say it's very situational. When volatility is very high, we can expect Vanna to help us, to assist us in the move going forward. Volatility is very low, it's not gonna help us that much, right? Then it's really just depending on the gamma, depending on that turbo to kind of truck us along and move us forward. Does that make sense so far? Right, I'm gonna show you guys in the chat, okay? So, how do you know when VIX is high enough to look at Vanna though? It's not dependent on VIX. For Vanna, it is not dependent on the VIX, and that's a little bit of sauce for you. I'm gonna help you out here in a little bit, though. Okay, so now that we kind of have this base understanding of how we can envision the data that we see on QuantData, this is my main page. This is my main page on QuantData. I'm just going to maximize it. I'll move the chat to the other side so I can still see if you guys ask any questions or I need to fix something. All right, so let's go here. Let's clear it. Let's clear it. All right, so this is my main screen on QuantData. There are days where things aren't that clear, right? I really talk about A+ setups, right? Mirroring those A+ setups, knowing when the market is telling us to hit the market hard or to kind of have starter positions or not trade, right? As retail traders, we are very blessed with the ability to sit cash. A lot of people, right? I've talked to guys at SMB, I've taken their classes. I've talked to a lot of guys working on the stock exchange, right? The New York Stock Exchange, because QuantData, we're allowed to go in. Do you think that they're managing hundreds of millions of dollars? They're allowed to sit cash? This is besides the Greeks, but they're not, right? Because if they were sitting cash and I was an investor, would I not be upset? Because I can hold my cash myself. Why am I giving it to you? Right? What, my tens of millions of dollars? Like, you're just sitting cash when what the heck? I just pop that in a savings account, put it on SPY. What the hell? Right? Doesn't make sense. So as a retail trader, we're blessed with the ability to sit cash and wait, be very patient with the market. There are some days that is very clear. So I'm going to bring you back to some of the days that we've had recently that were just so clear that it was obvious that we should trade and get aggressive. Okay, utilizing this stuff. So first one I think I want to show you guys is trifecta. Okay, now here in the chat follows our Twitter and knows what the trifecta is. Some of you guys know what the trifecta is. I'm gonna bring it back. I'm gonna bring it back to, I think it started to form at like the 10:30 mark. 10:30 mark. Yep, about 10:30. Sorry, just bringing my charts to the point that I want to see. Okay, here's your trifecta. Okay, so she's reading the chat there. I'm Greek to have any special edge. Man, I hope so. By the way, in this stream, I know it's being recorded, so fantastic. I'm going to be sharing the 3 A+ setups that I personally use and the ones that I've developed for like utilizing QuantData, and I openly share with everyone over in QuantData. So these are the days that I know that I'm going to hit the market really hard, right? You'll know from my Twitter when I post recaps, there's days where like I'll end the day sub couple hundred, 500, 800. Today we did 15. But then there's some days where like the market's, A+ setup right from the get-go, first hour of the day. I'm hitting the market hard, and there's days like June 15th where we closed out 7,200, right? Like that fluctuation is all based on what the market is telling me and suggesting to me at any given time. Okay, so May 13th, this is a trifecta. So the trifecta looks like this. It requires 3 things. It requires delta to be positive cumulatively. I cannot spell today. Maybe Google can help me here. Spelling, combatively, cumulatively. Oh my goodness. It's okay, you guys know what I'm talking about. Gamma to point at a singular strike above us. Vanna to point at that same strike. Let me zoom this out a little bit. Let me try this one more time. Cumulatively. Spelling not my strong suit. As you can tell, I'm Canadian, so that's okay. So we'll repeat this. Delta to be positively cumulative, right? Cumulatively positive. We need price below us to be positive by a large margin. Normally the number for delta is 2.5 billion. And this, by the way, I'm going to show you this trifecta first because this is going to help you guys take what I just taught you and like marry it together. You guys are putting it all together. Okay, gamma to point at a singular strike above us in price. Normally, the number is 70 million. And there's a very specific reason as to why I'm adding the numbers there. Okay, Vanna to point at the same strike. Doesn't matter. Doesn't matter what the value is. So 1, 2, 3. Delta, gamma, Vanna. Trifecta. Understand so far? In the chat? You guys kind of figured it out? Understand. Okay, perfect. We're going to move on. So when we have these three Greeks, right? 1, delta, gamma, Vanna. What do we see? Delta, very positive, right? Very positive. Let me bring up TradingView really quick too. I want to bring you back to May 13th. So May 13th. May 13th is like quite a ways away. What the heck? May 13th. We're almost there. May 13th. Okay, so take a look. This is your May 13th. Okay, so May 13th, we just kind of grinded upwards, right? All the way through. I want you guys to pay attention to the levels. I want you to pay attention to the levels that we have here. Okay, there we go. So delta, positive. It's telling us the engine is already running. Okay, it's telling us that the market makers have already made a decision. You open the market and they're like, okay, we want the market to close above a certain strike. Delta is used as support and resistance. Okay, so delta is used as support and resistance. What this tells us right here at 7,400 is that there are 3.24 billion positive delta and only 1.29 billion in negative delta. This tells us like cumulatively, right, the bulls are winning here. The goal of the market maker when they have a view like this is to tell us that not a directional sense, right? Think about the engine, it's running. Their goal is to just have price close above 7,400, even by 1 penny. Even by 1 penny, the market makers win this trade. Does that make sense so far in the chat? So it's not a directional Greek. This Greek is support and resistance. It's telling us that the market makers should not, within a certain percentage range at 2.5 billion, they will not allow price to close below 7,400 by 70%. And repeat that again. At 2.5 billion delta, the market makers for 0DT on SPX will not allow price to close below 7,400 up to a 70 percentile. So 70% of the time, if we actually just sell 7,400 put credit spreads into the market when that delta is above 2.5 billion, we win 70% of the time. Does that make sense? I'm talking about probabilities here. This is something that these chart pattern guys can't give us, right? 70% of the time. So, okay, in the chat, you guys give me that thumbs up if that makes sense so far, because I know that I ramble sometimes. I also need water. Perfect. Okay, so that's step one, number one for the trifecta. It's telling us support. There's support in the market. What is gamma telling us? It's telling us that the turbo is spooling, right? There's some sort of interest for the market makers to get us to this area because this area, 7450, is the most valuable contract. It has the most gamma exposure in the market right now, right? What does the gamma kind of tell us again? When we think about that car, that turbo spool, it's going, right? It tells us the peak of the interest for the market makers is right there, 7450. Okay, now, generally, this is how accurate we can be with using quant data and using exposures. We can predict that 7450 is very likely going to be the top of the market. Why? How do we know that? So here's some things that you guys can also use for your alpha, for your understanding. The market makers spend a lot of money, a lot of effort, a lot of capital to move price in a direction. They have to do a lot of things to move price in a direction, right? So if there's no gamma values for the market makers to take advantage of, why would they move further than 74.50? This is the peak, 74.50, that's it, right? 74.60, take a look at the difference in 74.50 and 74.60. 74.60 has 17 million gamma, 74.50 has almost 50 million, right? It's not even at the 70 million percentile yet. Not only that, as we look through, we have the trifecta, right? Vanna is also pointing in this direction. So here we go. We put it all together now. Delta showing support. Gamma tells us the turbo wants to spool this way. It wants to go to 7450. Vanna, your girlfriend, right, also wants to go to 7450, right? Makes sense? Where do we think the market went to on this day? Where do we think the market went to? And where do you think the market closed on this day? Yeah, we went to 7400, went to 7450. We actually went to a high of 7460. But why do we think that at 7460, it's a good time to actually attempt a short if you didn't make enough money yet for the day? Why do we think that you would want to short it above 74.50? Give it like $5 flex room too, 74.55. Because the market's not interested there. The market is not interested. The market makers, sorry, are not interested in closing price above 74.50. There's no value for them to do that. They have no interest in doing so, right? So this, when I see the market do this, when I see the market kind of present these ideas to me, right? That one, the market, the scenario that I'm drawing up, well, the scenario is already told. Like the story is already written right here, right? They want long. So why do I need to do anything else aside from getting long, right? Or finding ways to find an entry to get long. That's where you can start using whatever indicators that you guys want to use. But you'll know for myself, I base things on premium, right? So that's number one. In the chat, let me know. Is the trifecta solid now in your brain? We're going to move on to the next one. Trifecta solid. Yes, yes. Is it easy enough? Right? So the next time that Alex is on stream and you guys are all watching him do his thing, right? And he sees this and he shows you this, what are you going to do in the chat? Get long, right? You're going to try your best to get long and strong, right? And I know Alex is going to definitely bring you guys to the forefront with trading. This is the way to do it. So moving on to number two, we're going to talk about, so this primarily is a bullish strategy. It doesn't work really in a bearish strategy. Why is that? Because in a bearish scenario, usually it's not gamma that's dictating where price wants to go. It's Vanna. And that also tells us that volatility is very high, right? Volatility is fluctuating. You're getting all these ripper candles up and down, right? So this is a bullish strategy primarily. And with this strategy, I'm going to really quickly share with you. We're going to move on, but I'm going to share with you really quick this graphic that we made in the chat. So this is what I mean when we talk about. Oh, I can't post a picture here. Maybe someone else can later. But this is what I mean when I talk about actual studies in the market, right? So we have this graphic. Anyone in the chat, do you guys know what the MVC is? Yep. So this graphic, by the way, I'm showing you this because it goes directly with this scenario, with the trifecta. On other scenarios, the other two A+ setups I'm going to show you doesn't actually apply. So in an A+ setup, right, we just talked about how price closes and reverses from the high. So we went to 74.60, we immediately reversed, and then we closed at 74.40, right? So in this study, it tells us the MVC, right? So the MVC is the most valuable contract on gamma side. It's the contract with the most exposure. So we see 74.50. we know that in a low volatility environment, meaning 20% and below in IV, which is right here. You see that right here? Yellow line. 20% IV tells us that 72% of the 0DT session, we will meet the most valuable contract within the first hour. Okay, so 72% of the time, low volatility leads us to meet price at 74.50 in this scenario. And did we meet it? We met it. That's higher than a coin flip chance, right? So we met it, and then not only did we meet it, the frequency of it after. So pivoting. So we give the MVC around $5 flex room just because of volatility. So we know that 54% of the time when we meet that MVC, price will reverse. Okay, so that's a pivot spot 54% of the time. 28% of the time, the market actually closes within $5 of that MVC. So the market would have closed if it was 18% or 28% of the time. It would have closed at 74.55 to 74.45. Okay, makes sense? The last scenario that we have, is 18% of the time we close further, more than $5 away from the MVC. In the chat, makes sense? And this is just really quickly, I'm just going to share that this is actually why I like credit spread so much in options side. If you're trading futures and you're trying to utilize this MVC study, you can't actually increase your odds of a trade as much as what this is shown. What that means is when price reached 74.50, I can sell call credit spreads at 74.70, expecting price to not go further more than $5. Because in that scenario, right away, I've already put on a trade that has an average of 82% win rate. Because if you put 54 and 28 together, there's not that high of a chance of us going right towards and closing beyond where my call credit spread would be breached, right? The most it would probably go is if we went crazy 74.60, right? But I've sold 74.70, right? I still have 10 points of wiggle room for my contracts to expire, right? So with this study, like this is actually why I kind of gave up on futures. Like I didn't really see the value there enough to do it. So the sample size of the study, we ran it all the way back to 2024 from the start of the year. So there's a little bit more than that too, but then the data gets a little bit wonky because it's also based on a lot of journal sample sizes. So, but yeah, that's it. That's kind of what we have here. And I don't think I can post it in this chat. That's okay. I'll send it to Alex after, and then he can share with you guys.
Send it over to me. I'm going in the chat because I turned it off because of a bunch of
People getting crazy.
yeah. You can send it
Oh, I
over to
get
me.
it.
I'm doing it right now. Just give me a
Oh, it's
sec.
all good.
I hope I can send it over. I know. Let me check.
I sent it to you. You can send it to him later. Okay, we're gonna go through the next trade structure. This is the next trade structure that I really enjoy. This is actually so trifecta is actually the third one that I like. The next A plus is called the delta flip. So you guys are saying that this right does it work for the opposite side? So for downside, it does not. Because of volatility. But there is an A plus setup that does work for the downside. It's called the delta flip. Now, there have been other days that it's happened, but the most visually appealing one that's happened is November 20. I'm going to show you November 20 really quick. November 20. November 20. Okay, so we are going to reset the zoom. Actually, yeah, we're going to reset this stuff. Zoom, reset the zoom. Perfect. So what do we kind of maybe I'll go here actually. This is a little bit better. Maybe here. There we go. We'll do November 6th here. Or November 20. I don't know what I'm talking about anymore. Going crazy here, guys. November 20. So here's November 20. We are going to look through it here. Okay, so in our minds, right? Open the market. What do we think? What do we think? open the market. This is delta. So delta is suggesting that there are a lot of long participants in the market that want price to hold above a certain strike. 6,700 is a very obvious one. 6,750 is a pretty obvious one. But we can see that it's not 2.5 billion, right? Do we see 2.5 billion on any of these strikes? No, not really. So if so, the reason why 2.5 billion it matters is because 2.5 billion, what we found again is the 7th percentile, but market makers, unless there's a catalyst, they're not really willing to spend the effort and the capital it takes to flip a strike that has over 2.5 billion in long deltas. Normally, they'll try to influence it with new deltas. And I'm going to show you that in a second here. But they don't. They won't flip it entirely, which tells us that this is still going to hold through. So November 20 showed us from the open that participants were long. And if we go to right to the 11 a.m. mark, right, we can see it's a little bit more messy. Price did start to kind of dance around the 67.50, 67.30. So this is delta flip. So delta flip requires over 1 billion in long deltas to immediately deplete and flip, literally flip the other way. This is a bearish scenario. We have seen it sometimes for bullish scenarios, but normally it's actually better on the bearish scenario. So this is why I call it a bearish strategy. What do you guys think happened? What do you guys think will happen in the next 1 minute? A move? Of course, sir. Of course it's going to be a move. Let me show you stock price real quick. So November 20. So this right here is 11 a.m. Okay. This is what happened to the market afterwards. We just straight flushed. Here's how we knew this was going to happen. Can I bring it like this? Yes, I can. There we go. You guys ready? Ready for some magic? This is how we knew in the Discord that this was going to happen. 14K on the single day. Bam. What happened? What happened? So you can see right here, 6,700 was long 1 billion, like 1.5 billion or something like that, right? And then in 1 minute, bam. So what does that tell us the market maker is doing at this point in time? This tells us that they no longer want to hold their position of long on that strike. They've decided to flip it on its head and go short, right? So now what do you think happens in the next few minutes, right? We knew that was happening, right? The moment that happened, we're like, wow, okay, market makers have changed their decision. What is the new scenario for price? Let's go. Let's go 1108, right? More devious, more dangerous. Let's go to 30 minutes. Bam, what happened? Immediately, we start to just flush it through. This is SPX. Make sense? So this, with our understanding now, the delta has reversed its engine. It's going in, and you put the car from D to R, right? You guys can tell I'm not a car guy, but right? Is that not easy enough, right? So we bring it back to these chart pattern guys. Okay, they're drawing these things. What are we driving? Like, what are we drawing? Sorry, we don't need to draw anything. We already know the market makers flipped 6,700 from 1.5 billion to negative 1 billion, right? Couldn't that happen the other way around though? Not always. It's not as strong on the other way around. This is usually an indication of a very volatile move coming down. So I remember like what happened on this day. We saw that flip. We gave up on our put credit spreads and we ended up buying long puts instead and selling calls at 6,700, expecting price to never revisit 6,700. So let's go through the day a little bit more. So after we lost 6,700, take a look at the deltas at this point. So this is New York City launch, like near the midst of it, near the end of it. 6,700 with 3 billion in negative delta. Do we think the market makers are willing to buy back all their short deltas at this point? Do we think that? Right, 6,700 and now it's 3 billion negative. That's a lot of money. Not only that, halfway through the day has already traversed. They're not going to buy it back. So us as traders, we can make that decision. Okay, every long opportunity is better value short. Not only that, we can also say that if there is an opportunity to come along, we can sell that call into the market. That's what I do, right? I sell options. So I sell a bunch of 6,700 into the market, expecting price to never revisit this strike because the market makers are not going to buy this back, right? So delta flip, everyone understands it now? I'm going to show you the next one. It's called the delta wall. And with that, we're going to show you as well what new deltas versus old deltas can usually kind of sometimes tell us. Perfect. Okay, I'm really glad you guys are understanding this stuff, by the way, because so I live and breathe this stuff. I do this every single day that we're trading in the markets. So we are going to run through delta wall. Now, I'm going to give you two examples of delta wall. Okay, I'm going to give you two examples. They're going to be very good examples because it's me. I'm here. We're going to go to, I think it was June 15th. So June 15th, and then we're going to go to July 10th. So June 15th first. Reset here, go to 9 a.m. And then let's do this one right here. Okay. Okay, people in the chat. What do we see? Left's the delta, right is gamma. What do we see? Long, is it? Is it suggestive of a long? Here says, yup. Look at the convexity. Oh man. You know, I love the bonding you guys have here, the characters. So what do we see here actually is not a trifecta. If I bring up Vanna, it's actually not going to look the same. So I'll show you Vanna real quick. Vanna kind of looks like an absolute mess, a little bit, right, from the open. But we're using gamma as a target for price, right? So in this scenario, where's the target for price? If we're looking at gamma to give us the idea of a target for price. Not 7,500. Why is it not 7,500? Because that would be looking backwards. That's looking backwards. We're not looking at gamma for us to be a magnet downwards. It would need to be negative. So right now, the delta wall is 2.5 billion, right? 2.5 billion positive. That's what I said earlier. We opened with the market. 7,500 has 4 billion positive. So the market says 4 billion positive deltas here, right? In the market, right from the open. Gamma isn't suggesting that we move forward. Gamma actually just tells us that where we are is a valuable zone. But for sure, the market makers are probably not going to allow us to move below 7,500, right? Because we don't have, like, think back to May 13th. What did we have for May 13th? We had 7,450 above us in price. Be very exposed, right? We don't have that same view here. But we do know we have one metric at least that's helping us, and that's, again, the 7,500. So 30 minutes into the market open, let's go to 10 a.m. You can now see the change, right? Is the market still telling us that there's a target for price? No, there isn't. There's still no target for price because we're already there, right? But what we do see is that 7,500 has now expanded by another 500 million, another 600 million actually in long deltas. So now with our thinking caps, understanding quant data, understanding exposures, do we think the market makers are going to allow the price to whip below 7,500 for them to lose on that trade? No, right? So in this scenario, the delta wall, it really only works if you're a credit spreader, but what I did on this day was just sell puts. I sold puts, and I sold a massive amount of puts at 7,500 because I knew already if 2.5 billion gives us 70 percentile that we do not cross that strike, at 4.65 billion, that percentile is way higher. It's going to be in the 80 percentile that we're not going to see price whip below 7,500. So let's take a look. What did we do? So price did move up 30 points. We moved up a little bit higher, but then we started to turn around, right? We didn't really get 7,500 to retrace, right? We came back around a little bit, but gamma again wasn't suggestive of us moving that far. So this is the other way that we can use delta wall. This is why this is my favorite setup. I'm going to bring you to the day where Trump just gave us a little bit of heartache. I believe it was July 10th. So does anyone remember what happened July 10th? So here's what happened July 10th. I'll show you real quick. Similar scenario. Very similar scenario. Now, this is something I want to showcase to you guys because I know a handful of traders, even in the QuantData team, like I knew that this happened. Trump tweeted, right? Everyone got scared on this candle right here because it dropped us 50 points, and everyone was like, "Oh my god, like it's over for us. We gotta flip short. No more longs. No one should be long here." Is that true? Is that true? Obviously, in hindsight, 2020. But during the moment of it happening, we can be like, is this really turning around? I'm going to show you. So 1032, mark that time, 1032, 1033. Okay, we're going to go here. We're going to go to delta. Oh, by the way, I don't know why I'm pointing with my finger. It's like a weird habit I have. I know you guys can't see my finger on the screen, but like I can see my mouse. 1032. This is what it looks like. This is back at 9 a.m. So we see 7,500. Do we have an A plus setup? Oh, by the way, I didn't actually record this. I think someone told me they were recording, so I didn't bother clicking it. It was gonna slow my PC down, but hopefully that guy's recording it. Anyways, 7,500. We have that A plus setup. It shows us 3.87 billion in calls, overall 3.35 billion in positive delta. This tells us that the market is long here. They have made a decision to tell us that price is no longer going to see 7,500. Not today, no matter what. Now, we do say catalysts could be a reason, but I'm going to show you right now. So keep your eyes on this delta. As the market made this rip down, 1030, 1033, what do we see? Is it still cumulatively bullish? Price went, by the way, to 73.08, 73.08, by the way. I think that was the lowest that we saw. But what do we see here? It's still bullish, right? All we saw were new deltas coming in. So new market participants started to try to short this market. But the old guys like me, 34 years old, right? They're still here. 3.38 billion. Has that budged? It didn't change, right? No one who had the long 7,500 sold. They're still holding it. So during this scenario, we can make a assumption that, okay, if the market isn't changing off this catalyst, should we change our bias as traders? Should we be like, oh no, it is turning around based on these candlesticks? Do I need to flip bias and not get long anymore? Or do we add on more confidently, and were we given a better opportunity to get long, to get a better value long? Yes. You can bet your ass that on this day we doubled down. I posted a reel about it with QuantData. We doubled down on this day while everyone else was like scared. I know. I remember in my chat, they were like, "Oh no, EBJ, what are you doing? We're scared. Trump said the Iran ceasefire is over for the 50th time. Like, what's happening?" Yeah, I did post a video on this. You're right. So this is how we can use this data to kind of find confidence. I think that's the most important thing as traders. We struggle with trying to find things that tell us confidently that we should be in, we should be out, what should we be doing, right? That's the person. I think if you're a trader and you're kind of brand new and you're looking for like just like answers to the market, I think everyone thinks that technicals is what they need or just more data, more setups and stuff. Feel free to steal the 3 setups that I just gave you guys and run wild with them. I don't care what you do. You can just there's more than enough money in the markets for all of us to take advantage of. And if you guys learn something from these 3 things, let me know. I don't want to take up all the time. There's still about 20 minutes, so I'm going to open it up to questions from you guys. If there's anything you guys don't understand, let me know. I'll also I'm still going to be in this Discord for a little bit, so you guys can ask me questions, ping me, and then after my streams that I run, I will pop in here and answer questions. Because I've seen a lot of Alex's work. He's been doing great, and I'm really happy that he's putting more eyes on this stuff. What I kind of equate quantitative to is like candlesticks. You're looking at the car, you're looking at the paint, you're looking at like the rims, right? I don't know if people still spend money on rims, but it might be like an old person thing. But when you're looking at the data, you're actually looking at like underneath the hood. You're looking at what's actually driving the market, what the market is actually telling us. That's what we're doing. So you can kind of imagine like who's that guy who in here? He drives like like a super old Nissan or something. Like I bet you if you flip open his hood, it's like a twin turbo, like crazy V12. I don't know, dude. um, yeah. Any questions? Let me answer. From. Oh, by the way, Alex, actually, you take over. Is there anything that you wanted to bring up? Because I know I went on a ramble here for like an hour.
Yeah, man. Appreciate it, man. Was just amazing, and thank you for your effort. It's definitely a new perspective for us because the way we trade based on gamma levels only, and we use them as levels as our locations. But
Mm.
your perspective is kind of fresh, right? So we trade futures. We're mainly, young and aspiring, you know what I'm saying, prop firm traders, and we trade futures here, right? So on your side, you're more trading options, credit spreads, the magnet. So this magnet of the strategy, right? With MVC, it's just impressive, right? The way we trade, uh, we use gamma exposure levels as locations, and then we combine it with net drift. That's why we really appreciate net drift. We really appreciate quant data because just I never seen someone else doing this. Maybe some, other softwares on SPX on with SIBO data, but for this price, for this, this price quality that Quant Data offers is just, it's insane. So NetDrift is probably the best thing that I ever seen in my life, and for 6 years of trading, right? So it's not too crazy, but still, right? So basically, everyone's saying that it's all about trend, trading with the trend, right? And go with the flow, right? So you want to
Yeah.
go and you want to follow aggression, but how do you identify the trend, right? So here, uh, with quant data, you can look at these numbers, right, and you can see the side that's winning, and it happens every single day. So, for example, on I think on Tuesday, what happens is what happens usually is, for example, if you go on QQQ net drift, that would be cool. I think that's what, yeah, 21st, yeah. And if you pull up QQQ, yeah, see that? So uh, we've been pulling back all, I think for good 45 minutes, right? We've been going down, right? But look at the net drift. Net drift was kind of, indecisive, right? So um, we did not see a put heavy environment. This is how I call this, right? And
Yeah.
another thing, I think it's my invention. I don't know, but how I call this a synthetic move, right? Synthetic pullback, fake pullback, right? So the move is not supported by sellers basically. If you look at I think NDX was supporting it, but on QQQ, this is our primary asset. You can look at, I think 10.15, yeah, 10.15. This is where calls started to pick up. So I was sitting there for 45 minutes and I was thinking, well, this move, this right here, that's a fake out. And just imagine how many people got blown inside of this, inside of this range, blew their accounts and lost a bunch of money, right? And only this thing, only by using NetDrift specifically with 0DTE, OTM, with your filter on, uh, this is how you could avoid these unnecessary losses. This is basically, you got like long and short opportunity, you cut it in half, right? So you can only take longs. Otherwise, you just don't follow your rules, right? If you're aware of it and you take shorts, then it's your fault, right? You can look back and you can say, okay, well, that's my fault. That I can at least uh, I can at least be sure that I take longs only, right? So that's one of the examples. Today, for example, that was insane. So on NDX, what I saw around my entry, someone sold around 1 point. Yeah, if you pull up NDX specifically, that'd be cool from today. Someone sold, I think, like, give me a sec. I think your expiration is not right. Is it? Yeah,
Yep,
zero
you're right.
DTE.
Just change it to
You're
today.
not.
Yeah.
Yes, sir. So you see around 9:45, this is where I took my trade. This is where I took this short. And just look at this. Someone sold, what was that, like 2 million? Yeah, 1.5.
Yeah.
Yeah, 1.5 calls. So it's saying to us that someone's stepping in inside of this market. And on NDX, it happens a lot, right? So you have to filter this out because it has a bunch of institutional volume. So basically, we go with QQQ. But QQQ was also negative. So that was my kind of extra confidence, right? And also, what's important is to combine it with gamma exposure level. So this is how I go. And coming back to that FTMO example, that was absolutely insane. If you go back to this 10th July on NDX, specifically on gamma exposure, this is the art. That's absolutely crazy. So I think it was on 10th July, right? This is
10th of
this
July.
is when this FTMO happened. Yeah. If you go on NDX, yeah.
Right here.
My favorite filter, yeah, my favorite filter uh is interval map, right? So this is like these bubbles, being able to
Oh,
look at
interval
them,
map.
see the history behind it. It's just absolutely crazy what you guys built. But if you go on this, yeah, exactly, on 10th July, and you just visually, yeah, look at this. So um, during FOMC, you see this huge positive gamma exposure there, right? At the top. And this is where we end up, right? So that's just, it's just one of the examples. It happens every single day. Same if you go on Monday, this Monday on NDX, same, just crash the market. So I think, yeah, 20th, if you go on 20th, yes, sir. Just look at this. Look at the beginning of a session, 9:40. We've had, I think, 500, yeah, at the top. At the top screen, you see this like bunch of these green bubbles. So we've had, like, I think on my end it was, yeah, you see 100. Oh, is it delta?
142. Yeah, a little bit
Oh,
crazy.
yeah,
And
you're
then
on you're in
it
delta,
just
yeah, on delta. But pretty much like for NDX, just imagine this. That's absolutely insane. Like it can get easier than that. Trading cannot get easier than just looking at these levels, seeing them playing out. And yeah, it's just impressive. It's just impressive, and representations of it. Net drift combining with interval map, that's been bread and butter for me, right? So your perspective is also very nice, right? Looking at gamma by strike, looking at delta, trading SPX. We're kind of the opposite, but we trade the same instrument. So I think this session is going to be very beneficial for this community because it's going to give you these options, right? So you can trade futures, and then you got ABJ. You can hit them up, right? Ask them, ping them whether it's right. You can DM them. So
Love
yeah,
it.
yeah, um, that was all for me. Thank you so much for your time and for your attention. Thank you for putting us on because we need that. We need some information on options because I'm a futures trader. I tried to trade options when I was on vacation, but I was unfocused. So
I like.
yeah, the best is like kind of futures. This is how we've been doing this.
I
Yeah.
love futures too. It's a great instrument. I only personally I only use futures now to hedge myself. Like let's say I sell a put and price is actually coming down. I would use futures to short so that I at least accumulate some of the damage that I'm looking to expect to like I mitigate some of the damage that I'm getting to if price is actually coming down. But I still believe that my position is not going to get breached. The reason why I switched to options primarily is just I kind of just did some math, and I was like, I was running through like every quarter I do my journal. I talk through it with my wife, and she's just like, you actually don't make that much from futures in comparison to options. And then the other thing I really like about options is that we can continuously hedge. So one thing that I think weaned me off in the end to just totally quit futures as a directional instrument is that one, we know the market can only go in one direction. It can either go up or down. Two, it can only go so far in that one direction. So even if the market is going up, it can only go up so much in one day. That means there is a ceiling that we can sell. And if it is going up, then we can take advantage of it by selling the floor because we know that, well, market's going up, it's not going to come down. So we'll start selling puts in that way. And eventually, if you guys have seen my trading, the end result of my goal is to complete an iron condor. For anyone who knows what an option is, we sell a call option and we sell a put option. We sell the floor, sell the ceiling, and then we let the market close in between we sandwich the market in between these two strikes so that we just collect the full premium of it. Um, I don't know. I think honestly, it might also come with age. Like I'm 34 now. I know there's a lot of futures traders that are old too, but I was always punished for not being quick with my trigger finger to press buy and to press sell. With again, well, options we can just breathe a little bit more. If I miss an entry by 5 minutes, it's still okay to get into it because there's still value in the options contract to do so. So yeah, I really appreciate that. And one thing about Quantia that's really great is that you like the interval map. I don't use the interval map anymore, but there's so many tools that we can use. You can kind of pick and choose like all these different tools and utilize and hyper focus whatever it is that you want to marry it with your strategy. Or like myself or yourself, you can kind of um, create a whole strategy just like around quant data, which is how I shared with you guys my three setups. Without quant data, like you wouldn't be able to execute those three setups, right? um, let me check the
Yeah, the
chat. I know there's a few questions.
amount of tools that you guys have, that's just absolutely crazy. So only like along dark pools, I'm not using them, and I don't, because I'm all about dealers hedging and all that stuff and options, right? But equities, what's going on there? What's on dark flow on dark pools? It's also very impressive. Volatility tools, it's very nice, and it's also uh, makes sense because um, you mentioned that you like to trade options. Well, options, it's very flexible, right? So you can
Yes.
bunch of strategies. You can speculate on basically what you are doing. If some of you guys don't understand, um, ABJ, aka William, or vice versa, he's speculating on price not going there. So
Yes.
7,500, let's say, I'm going to make money if price is not going to go there, right? So this is how he does it, right? In the futures, we buy or sell, right? So these are our only options. But the benefit of futures are prop firms, right? So we are all about prop firms, and
Yeah.
we use this convex payoff structure, meaning that if you rotate the accounts the right way, you're going to make money even with negative, negative RR, with basically not generating alpha, but you're going to make money, regardless. You're just going to have to follow your rules. If your strategy, even if it's not profitable, you can abuse the convex or like benefit from convex payoff structure. So this is in the future space, and those accounts are very, very cheap. So
Yeah.
you
I've
can
seen them.
probably, yeah, I've seen some of the options prop firms. They're not as cheap, right? So basically, you got to pay a fee like, let's say, $300, right? Here in the future space, you got to pay like probably $75, $100, and you can get funded, right? So you have this activation fee, and you don't risk your own money. You risk this activation fee that you put down. So and the end goal is to get payouts, and money is real after that. So you get paid real money, but you invest. It's basically ROI game, return on investment. So both of them are amazing. I say for prop firms, you should use futures, and then for personal account, for long-term investment, I'd say it's all about options nowadays, because you mentioned that you started to do options back in 2022. This is where zero DTE got introduced to us, and look at zero DTE right now. It's like
It's crazy
55,
now. Yeah.
65, yeah, 55, 65% of overall options volume. So just you have to benefit on it. You have to capitalize on it. You're going to stay on the side. So yeah.
Just answering some questions in the chat by typing. Someone asked me, how often do you get these setups? You don't get them that often. In my opinion, from the time that I took when I was taking all of SMB's courses, if your A plus setup shows up every single day, it's probably not filtered enough. It's probably not filtered enough to have some sort of high win rate, high probability of success. Um, you have to filter enough to like really be pinpointing exactly what you're looking for. So the last A plus setup that we had was, I think it was last month. Uh, it was July 10th actually. I think that was the last one that we had. So they don't show up every day, but they do come often enough for us to make decent amount of money. Katie looking at the Tampa, usually charging. Okay, so I know you look at SPX. I know a lot of you guys look at SPX here. Sorry, NDX here. I don't like looking at NDX because the options chain is actually pretty thin. Sometimes with SPX, well, I mean, you guys take a look here. If your goal is to follow the money, which is what I base my ideology off of, well, where's all the money going? Here, take a look at the premium right here. All the money is going towards SPX, the index, and then Qs is second. NDX doesn't even show up. The reason is because it's such a large asset, um, but that doesn't mean that you can't use it, right? It is a very large asset, but the players that are involved in NDX, they're probably going to give you some of the clues. I've just traded a lot of SPX, and when you're trading credit spreads, most people just trade on the SPX. It's the most liquid for credit spreads. I've never Actually, I've tried NDX before. It's just like the fills are crazy. Like the bid and ask will be like 50 or 70 cents away from each other. SPX is at most it's like 15. So it's just more favorable to be done on SPX. Hopefully that answers your question. Can you explain your SPX trade you had on yesterday? You had almost 100 put credit spreads, risking 200K to make 3,000. Isn't that crazy risk? That's a really, really good question. So I'm guessing you're talking about the post I made yesterday on Twitter. This one here. This one here. So it's actually not 100. You cut them in half. So on my platform, two legs, so it's 22 on each side. So it's actually just 22 spreads. And on this day, what did we do? We tripled down, right? When it seemed obvious that we were going to win the trade. That is something that I do a lot of, which is if I'm in a trade that's winning and I'm very confident in it, even though the spread is worth less, I'm willing to put more in just because, well, I know it's going to expire worthless. Like I know there's no reason for me to be worried about these strikes. Look how low we sold, right? 73.40, 73.25, 73.55. The market was not going to go there, right? Hopefully that makes sense. And then if you're talking about risk involved, a credit spread is you're using a lot of margin to use it to activate these trades, but you have stops, right? Do you have stops in place, or are you someone who trades with no stops? In my opinion, if you're trading credit spreads for the first time and you allow things to go to max loss, um, I have questions for you, and I have questions as to what it is you're actually trying to do in the markets. Are you holding on to things for dear life? Because that is not what you want to do, right? So there's a couple more questions here. I know we're gonna end it in like 2 minutes. Young and live with blow accounts. Oh my goodness. Brody, how do you measure your win rate with options flow? Do you code it? No, I think I just answered that to you. Good question. How does QuantData compare to Spot Gamma? I used to use Spot Gamma like way back in the day. Before I started using QuantData, I was using all these other services. Spot Gamma and QuantData, one of the main differences is that our calculations are different, right? So with QuantData, all the studies that I've published, all the things that I have on that you'll find on my Twitter page, like they're all based on the calculations that QuantData has provided. Hopefully, that's good enough. Like if you like Spot Gamma, if they're cheaper, if you just like their product better, like by all means, I'm not going to be opposed or upset. But I think we offer a lot of things. We offer a lot of tools. I think we're the only ones that have someone stream and trade it live for you guys. I don't think Spot Gamma does that, but maybe they do now. Maybe they've followed along and done that. I don't know. But yeah, there's a lot of things. Sharing your template. I think my template. Sure, I'll take a picture of it. I actually think it's better if you just remake my template because if if I share it and the filters like don't line up, or if I change something, I think it's gonna change for you too. So I'll screenshot it and then I'll send it to I'll send it to Alex and then he can share it with you guys. Is that an AP on the wall? It's custom from Etsy. I think the one more question. Where can we access these study materials? This is really good. Homework for you guys. I want you guys to study these things. So what is delta? What is gamma? What is vana? What is charm? Accumulated together. Why do market makers have an obligation to get to these levels? I'm gonna leave you guys with one more note, and then I'm actually gonna take off because I gotta get lunch with my wife. You guys ready for this last question? Or not question. I'm gonna go through this last thing that kind of puts things into perspective. In the chat, let me know. You guys ready for it? Thumbs up? Yes? No? Yes? Okay, perfect. So the market maker we know generally wants to be delta neutral. Delta neutral means that they are actually flat. They don't want anything to be influenced either way in their position. In a normal market environment, which is currently right now, we are technically in a normal market environment. We have not flipped to a bearish environment yet. The market maker is normally short puts, short stock, and long calls. Three things. So there's short puts, short stock, and long calls. That is the general stance of the market maker. So what happens on May 13th? What happens when a bunch of us, me, you, Alex, all these guys, these big guys with millions of dollars, buy an insane amount of 74.50 calls? Remember the market maker's position. They want to be long these calls and they want to be short stock and short puts. What happens is that eventually we buy so many calls. We buy so many calls that all of a sudden the market maker is now short stock, short puts, and short calls. Are they still neutral in that position? Are they delta neutral? No. What have we done effectively to them? We've broken their neutrality, right? So in a scenario, let's bring it back to May 13th, and this is I'm gonna leave this off with you guys so that I can well take some time for myself. I've been here for a long time now. So in this scenario, we can see that we've bought all their calls. We've taken everything. Now they have two options. They have two options now that we've broken their neutrality. They can either push price down, right? Because their goal is to get us to sell our calls back to them. They want their calls back, but we have them because we bought them all. And they're obligated as the dealer to give them to us, right? I know it's a little bit confusing, but in the chat, does this make sense so far? We've broken their neutrality by buying all their calls. Yes, okay, makes sense. So they can either push price down to force us to lose and sell our calls back to them so they can have them back, right? Or they can push price up by buying back their short stock. In the act of them buying their short stock, we push price up, and then they don't care about our calls. They just want us to sell it back to them. So when they push price up, we see profit on our calls and we sell our calls back to the dealer. Now what happens? We've returned back to neutrality, correct? They are now again long calls because we sold it back to them, short stock and short puts. After they've bought back the stock that they were short, pushing price up, they have now got us to sell, offload our calls back to them. They can then again short the same stock at a new price. Why in this scenario that we see right here, why would they not bring the market down and make us suffer losses on our calls? Why would that not interest them? So this is how we can understand why the market moves in this way. When we see these scenarios, no, not that they want to be neutral. They wouldn't want to push the stock down because that's going to make their short puts expand and increase in price. They're going to lose on their short puts. They don't want that. They still have these short puts that they're in. They want those to win. So it's not in their best interest to short the market for us to lose money on our calls, right? So that's your little bit of homework. Try to do some studying. I know that when we put it all together like this, and I know it seems complicated, but when you put it all together and you finally start to understand what the obligations of the market makers are required to do, it makes it a lot easier for you to trade the market. It makes you understand why things are moving up, why things are moving down, what's the likelihood of a scenario being completed or whatever. There you go. So in the chat, thank you very much. Alex, thank you very much for having me. I gotta run to get some food.
Thank you, man. Thank you. Appreciate your effort. It was very, very insightful. I'm going to send the links on ABJ in the chat. So it's his YouTube and X. You can go follow him there for more material, even more than mine. I post probably every 2 weeks or like 3 weeks, and he posts like probably on a daily, right? So yeah, more stuff on you know more stuff on options. You can learn it by Williams. He can put you on, right? So thank you so much, man. Really appreciate it, and we are looking forward to repeat it. And yeah, just let's ask the chat. So how was it? How
Yeah,
was
let me
it?
know.
Gotta ask
Could
the
always
chat.
do
Do you
better.
fuck with that? Yeah, sexy. Yeah, of course.
Thank you guys. Thank you so much. I gotta run. So thank you very much. I'll be around the chats. If there's more questions, feel free to ping me. I'll probably answer everybody on Sunday. I usually leave my phone, like my work phone and Discord away on Saturdays just so I can really focus in on family time. So I gotta leave.
Yes,
So
sir.
thank you very much. Bye, Alex. Bye,
Appreciate it,
everyone.
man. Take care. Bye bye. So.